Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is part of a video series we started a number of months ago which track some of the recent Undervalued Dividend Growth Stock of the Week articles that were published on dailytradealert.com. I'm going to spare some of the introductions today. I hope you readers and I hope of course you viewers have been following along for the last few months and you've kind of got the hang of what this video series is all about. So we'll save some time today and kind of get right into the meat and potatoes, if you will, of what we're going to talk about today. So of course, the Undervalued Dividend Growth Stock of the Week series is an article that comes out every Sunday for Daily Trade Alert. If you're at dailytradealert.com, under the Dividend Growth Investing heading there, you've got the Undervalued Dividend Growth Stock of the Week tab, and that'll take you to the archive as we've talked about in prior videos and of course in prior articles as well. So you can see the videos that we've done thus far which track a selected recent Undervalued Dividend Growth Stock of the Week article, starting with Magna back in May. We're now coming up on the end of October, so it's been a few months now. I hope you readers and viewers have enjoyed not only the articles, of course we've been doing those for a number of years, but I hope as well you're enjoying the new video series which we started, and hope to continue doing them. Hope that it complements the articles and adds value and adds a little depth and everything else. So getting right into things today, the Undervalued Dividend Growth Stock of the Week article, the stock I chose to highlight in this video is General Mills, which was as of today, as of doing this video, which we're on October 26th right now, that was the most recent Undervalued Dividend Growth Stock of the Week article. So if you click on General Mills, it'll take you to the article which I've already clicked on, and I've already got it ready to roll here. As I've gone over in prior videos, of course, every article starts out with what I call a big idea, which is a buy-in for readers, which is an introduction, of course, not really just to what dividend growth investing is and why there's a lot of value in dividend growth investing, but in terms of a holistic lifestyle which prioritizes time over money, experiences over stuff, saving over spending. And once you start to get your mind wrapped around some of these concepts that I regularly write about, espouse, and that I actually live and breathe in my own personal life, this article kind of talks about a paradigm shift that occurs within your mindset. Once you start to kind of break the mold a little bit and you start to see the world a little differently, this perspective shift occurs, this paradigm shift occurs to where you start seeing the world totally differently, and things that were once thought to be maybe impossible or extremely difficult at the very least become not just possible, but actually pretty straightforward and not extremely difficult at all. And that's what I talk about in the article. I talk about how the traditional paradigm in terms of working, spending, this kind of never-ending process where you continue to spend a lot of your waking hours at a job that maybe you don't like so much in order to produce the income you need to pay your bills. If you're able to circumvent that process and you're able to generate income without the need to kind of trot off to a job that you may not enjoy terribly much, that's when that paradigm shift occurs. And what that is, that's financial independence. If you can bring in income without having to leave first thing in the morning and spend 8 to 10 hours away from home doing repetitive tasks and things that maybe aren't so enjoyable, especially after 5 or 6 or 7 years into it. A lot of people are working and doing maybe the same type of job for 30, 40, or even maybe 50 years of their life, and maybe that's not the best way to go. Maybe it is. You could argue that depending on what kind of person you are and maybe how much you enjoy what you do. But if you're financially independent, it becomes a situation where you can work because you want to, not because you have to. The things you start to do in your life, the things that you start to spend a lot of your time on become, it isn't so much about the money anymore, it's about the passion. And this video that I'm doing today, talking to you viewers today, is a very good example of that. I'm financially independent. I live in Chiang Mai, Thailand, which is a city where the cost of living is extremely low. My passive income, which is into the 5 figures now, which I talk about in the article and all the prior articles as well, that covers a pretty nice lifestyle here in Chiang Mai, Thailand. It can cover me in the United States. Before I left, I mean, I can live in the United States, but the amount of flexibility and freedom and options and opportunities that I have over here in Chiang Mai are significantly greater, and my lifestyle overall has improved dramatically. Getting back to my point though, this video that I'm doing today, these articles that I write, my blogging activities, my coaching, everything that I do it really because I love to do it. I do it because I truly enjoy it. So of course I make money at it, and that's nice, and I certainly enjoy being compensated for my time and skills and knowledge and everything, but what I do a lot of it really purely for the love of it. And even if I were significantly richer, if somebody wrote me a check for $100 million tomorrow, I would still wake up and do a lot of the things that I currently do. I really wouldn't change my life all that much. And so that's the paradigm shift that I'm talking about in the article. And of course we get into a little background on how that occurs. So the paradigm shift is a little bit of the why you should be interested in some of these strategies and some of these concepts that I discuss. And then I talk a little bit about the how later on in the article. And one major part of that how, that mechanism to get to that financial independence, for that paradigm shift to start to really occur in your life, is the investing portion of that holistic lifestyle. Once you start to save your money and you have excess capital, then you need to invest that money in order for it to grow and provide eventually down the road passive income, which you can live off of, which gets back to that whole circumvention that I noted earlier. And when we talk about investing, I'm a dividend growth investor. If you're watching this video, you're probably a dividend growth investor too, so I'm not going to get too much into the whys and the ins and outs of dividend growth investing. I assume that you have a little bit of that knowledge prior to watching this video, but dividend growth investing, of course, if you've gotten you probably have some knowledge base already built up, but it isn't just where you just pick random stocks and you just buy them at random prices and that's how you go about your investing habits. Of course, it's not a very intelligent way to approach long-term investing. And of course, this series is Undervalued Dividend Growth Stock of the Week, which means that each Sunday I'm highlighting a high-quality dividend growth stock that appears to be undervalued, and that undervaluation is extremely important because it confers a number of long-term benefits to the investor, to the dividend growth investor, that otherwise probably wouldn't be available if we were comparing that to the same dividend growth stock if it were fairly valued or overvalued. The dynamics would change quite a bit depending on the valuation. So when we talk about an undervalued high quality dividend growth stock, it generally presents a few key benefits, which I talk about right here. Those key benefits are a higher yield, greater long-term total return potential, and less risk. And I talk a little bit about how that works, and I talk about how that works in every article, and I word it a little differently and break it down a little differently in each article, but the overall high-level concept of it doesn't change. Buying undervalued high-quality dividend growth stocks, that was a great idea 30 years ago. It's a great idea today. It'll be a great idea 30 years from now. And the process of that, and the concept of that, and how you think about that hasn't ever changed, won't really ever change either. So the concept doesn't really change from week to week. It's just how I talk about it may change a little bit, but I kind of break down how those benefits actually work out and how they confer themselves to the long-term dividend growth investor once a high-quality dividend growth stock is undervalued, how that plays out when you actually get to the point of investing. And of course, I have a number of links in the article. One is to my personal, real life, real money dividend growth stock portfolio, which generates the passive income necessary for me to cover my basic bills in life, to cover my rent, my food, my transportation, my utilities. In order for me to get up every day and not have to worry about money, I have to make sure that my basic, my core personal expenses, as I call them, are covered, and that's where I'm at. Of course, I link to David Fish's Dividend Champions, Contenders, and Challengers list, which is fantastic, and we'll get into that in a moment. And then fellow contributor Dave Van Knapp has a long-standing and fairly lengthy series of what he calls lessons on dividend growth investing, which are basically a collection of articles that talk an investor through dividend growth investing from beginning to end, on how the strategy works, how to implement it in real life, so on and so forth. So getting into today's stock, of course, General Mills. If you've already read the article, you're a little bit familiar, and really, even if you haven't read the article, you're probably familiar with General Mills anyway. I talk a little bit about what the company is here. They were founded in 1856, so we've got 150 years or so of corporate history, which is pretty amazing. There aren't, you're not going to just run into companies every day that have been operating for 150 or so years. General Mills is of course one of those companies, though. They have fantastic brands in cereal, and maybe they're primarily known as a cereal company, but they are a lot more, as we'll talk about. But their brands in cereal include Cheerios, Lucky Charms, Wheaties, Cinnamon Toast Crunch. There are a number of cereal brands that they own, and of course that's a benefit and a drawback a little bit for General Mills, because they are very dominant in cereal, which is good in terms of shelf space, good in terms of scale, certain competitive advantages, but maybe not so good because cereal as a dietary choice, as a food choice, as maybe a bit of a food staple, the dynamic there is changing because a lot of younger people maybe don't eat cereal as much. They prefer maybe what they perceive to be, and probably isn't always if you really want to get down into the nitty gritty of it, but what they perceive to be as healthier options. And General Mills has adapted to that, but at the same time, because they are so dominant in cereal, that takes some time for that business to fully be able to adapt and make certain turns and things like that. But in one area they've certainly been very good at maybe being a little bit ahead of the curve on is yogurt. That's become an alternative to cereal, and they're extremely dominant in yogurt as well with their Yoplait brand. But the other brands they have, I talk, right here, beyond cereal, they're dominant in a lot of different areas of food: baking, pastries, ice cream, organic food, frozen pizza, snack food, soups, yogurt. Yogurt I just noted with Yoplait, but they've got a lot of other brands here: Betty Crocker, Pillsbury, Progresso Soups, Annie's Organic Food, Fiber One. Of course, is a fairly large brand now with a lot of snack foods and things like that. Nature Valley, also with the snack bars, Totino's, Haagen-Dazs. Personally, Haagen-Dazs is by far and away my personal favorite ice cream brand. And there's some licensing going on there with Nestle a little bit, depending on which country Haagen-Dazs is sold in. But that's truly an underlying brand for General Mills. And I tell you, I like ice cream quite a bit. I actually saw a video a while ago where they asked Warren Buffett what his favorite thing to eat for breakfast is, and if I'm not mistaken, he said ice cream. And then they asked him what brand, and he actually, I'd have to go back and find the video, so I don't want to misquote him, but I'm about 99% sure he also said Haagen-Dazs. He said, I hate saying it because I don't have anything, I'm not invested in Haagen-Dazs, but I think it's a fantastic high quality ice cream. So don't want to misquote him there. If I am wrong, send a note. But there was a video he did. It was a video he did with CNBC a while ago. They were asking him kind of just these questions that didn't have really anything to do with Berkshire Hathaway, just really personal questions, just really kind of funny personal things about what his everyday life is like. And that was one thing they talked about. I also know he likes Oreos for breakfast, and he doesn't own any, I don't believe they own any Mondelez, or if they do, a very, very small portion of Mondelez. So funny as it sits, but I always enjoyed Haagen-Dazs, and when I was able to finally invest in General Mills, it made me very happy because I'll have Haagen-Dazs here and there, and it feels good to know that I'm eating an ice cream brand, and I'm contributing to my own bottom line because I'm helping General Mills profit, which of course comes back to me in the form of that growing dividend. So getting into that dividend, of course, that kind of transitions into what we're going to get into right now, which is General Mills dividend, not just the dividend, but the growth of the dividend as well. And I note here they've got 14 consecutive years of dividend growth. As per every article, I get the dividend information from David Fish's Dividend Champions, Contenders, and Challengers list, which you can also find in Daily Trade Alert under that dividend growth investing heading. It's just just a few tabs down from the Undervalued Dividend Growth Stock of the Week article tab. And I already have General Mills highlighted here, and you can see consecutive years of dividend growth, 14 years. And backing up for just a sec, David Fish's this list that we're looking at, this Dividend Champions, Contenders, and Challengers list, it's an invaluable resource for dividend growth investors because it contains pertinent information on more than 800 U.S. listed dividend growth stocks. So if you're a dividend growth investor and you're looking at dividend growth stocks, you really can't, you almost can't operate without this list. It's that invaluable. It's just an incredible resource. So they've got 14 consecutive years of dividend growth, which is a really solid track record. We're talking more than a decade now. And based on the current trajectory of growth and based on the sustainability of the dividend, I find it highly likely that they'll not only continue to pay a dividend, but also continue to grow it, albeit at a slower rate than in the past, especially in the near term, and maybe even over the long haul. It just depends on how well General Mills adapts to some of these changing dietary trends, maybe what brands they bring on. Annie's they actually brought on board not too long ago, so that was an acquisition, and that gets them further into the organic space, which is all the rage right now. I have some mixed feelings on organic food and all these dietary trends out there, but that's kind of beside the point. But so anyways, we got 14 years of consecutive dividend growth. I note right here. And then we've got the 10-year dividend growth rate, which of course, that's something you want to know. You want to know at what rate annually are they growing that dividend over the long haul, with 10 years being a pretty good proxy for the long haul. And you can see that 10-year DGR right here, 10.4%. And one key thing I look at, which I've talked about many times, is whether the dividend growth is accelerating or decelerating. And we can see here a pretty strong deceleration. You see the 10-year at 10.4, 3-year 9.4, and then it just kind of really drops off here. 1 year 7, and then the most recent dividend increase was 2. So it kind of started off real strong, and then just really dropped, especially with the most recent dividend increase. I've talked about before that you never really want to make long-term projections based on what's happened over the last quarter or even the last year. You don't want to say, oh, I'm going to scrap 20 years of corporate history because the last quarter sucked, and okay, this business is terrible now. That's not really how a long-term investor thinks. That said, based on some of the numbers and what General Mills is doing, I do think that dividend growth going forward, we're not going to be matching up at this 10.4%. I think that's an unreasonable and unrealistic expectation. I would say I don't think 2% is a very good expectation either. Somewhere in the middle is probably pretty reasonable, as we'll talk about. But if you're buying General Mills because you think that you're going to get a yield, this really high yield, which is where they're at right now, and you're also going to be getting double-digit dividend growth, over the long haul, I don't think that's where you want to be, and I think you're getting the wrong stock if that's what you're expecting. Getting into the next thing, we talk about yield, 3.8%. When I wrote the article, it's still 3.8, so the stock is basically flat since I wrote the article, which it just came out not too long ago. So I wouldn't expect General Mills to really make any big move. It's not that kind of stock. It has a pretty low beta right here, 0.61. So beta, of course, is a measure of volatility relative to the market. It's not a stock that really pops or drops a lot. I mean, there was a little bit of a run up here. I think that was maybe not primarily, but at least strongly due to rumors that 3G and Berkshire maybe was going to take out somebody in the food space. They made a run at Unilever. That didn't really work out. There was maybe some thought that General Mills would be a target, and the stock really went way beyond fair value at that point. And it's really come back down here into it's strongly corrected to the level where I think, just like the run up was overdone, I think the drop has been a little bit overdone. Not too much, but I think the stock has come back down into a reasonable valuation, which we'll break that down as the video progresses. But this yield, 3.8%, that's well above the broader market. That's well above the industry, and it's certainly significantly higher than this stock's 5-year average as well, which is generally a pretty good initial indication of where the valuation is at. If you've got a stock that its recent historical average yield was, let's say, 2%, and all of a sudden it's yielding 3%, that 100 basis point spread that's a pretty good indication that, whoa. So this stock, investors are usually willing to take a 2% yield in the stock. Now they're saying it's 3%. That's where we're at with it. So what happened here? And that's where you got to start to make some decisions, and you got to start doing some research as an investor. The onus, of course, is always on the investor to try to discover, where this major difference is coming from, and why you've got that major gap between historical yield and current yield. And we can see that playing out right here. The 5-year average for General Mills, their yield is 3%. We're coming to 3.8 right now, so it's 80 basis points higher than its 5-year average. That's pretty significant. Some of that is due to that kind of overshot into overvaluation and really strong correction, which has pushed the yield up. Part of that is also just due to the fact that General Mills has grown their dividend faster than earnings, pushing its payout ratio very high. So what's happened is you're getting more yield now for less potential future dividend growth. So there's always that dynamic between yield and growth. The more yield you're going to get, the more growth you're probably going to be sacrificing, and vice versa. So you've always got to make that choice as an investor and look at that and say, okay, well, the yield is much higher than it recently has been on its historical average, but is that because the company's just paying out a bigger dividend now, and investors are saying, whoa, we're gonna kind of scale things back now. We want a higher yield because the dividend growth potential and overall underlying earnings growth potential is lower. So we want more yield for the risk that we're taking on when we buy this stock. And I think that's what's happened here. So, the 80 basis point spread is appealing. It's attractive. It indicates some undervaluation, but I don't think it's as indicative of undervaluation as it might seem at first glance. When you say, oh wow, the historical average recently has been 3, it's now 3.8. We might have some really strong undervaluation on our hands. I don't think that's the case with General Mills, and you can kind of see that play out here a little bit, guys. Their payout ratio 10 years ago was 40%. You see it right here on Morningstar. Their payout ratio right here, 40, and now we're at 70. So that aforementioned 10+% annual dividend growth has come about primarily because General Mills has just been they've been just growing their dividend faster than the business has been growing at. That it's very plain and simple. Especially recently, you especially see that climb here recently as General Mills' growth has really just kind of stopped. The business hasn't really changed much since about 2014. You see revenue here just kind of plateaued and start to drop off a little bit. Same thing with earnings per share right here, 283, 277. So the business is just kind of not really gone anywhere over the last few years. But the dividend has continued to grow, and General Mills finally, I think, recognizes that, peeled the recent dividend raise way back, which is really what they should have been doing a couple of years ago when they saw that the business wasn't really making some stride. They should have toned that dividend growth down prior, but that's okay because investors buying in the stock today are kind of benefiting from those prior mistakes, raising the yield higher than it should be as that valuation is adjusted. So you're getting a bigger dividend now versus maybe what would have been a smaller dividend had they peeled that dividend growth back a little bit. So you've always got to kind of look at all these dynamics. Investing doesn't exist in a vacuum. There's always a number of different aspects occurring all at the same time, all simultaneously. So that's what we've got. We've got a yield certainly well in advance of its historical average. It's also, I meant to note here too, I clicked off the tab a little early, but I meant to note, you can see the industry average in the broader market too. So General Mills is at 3.8. Industry average 2.4, broader market around 2. I mean, that's pretty significant there. So General Mills as a stock is giving you much more income than the broader market, and certainly much more income than what you get on an average industry stock, a competitor. So you'd have to look at all the competitors in that space that are competing against General Mills, average out their yields, and that's where you're going to get that 2.4 that they came up with. So General Mills is very much on the high end of available yield in the space, which as someone who is living off of growing dividends, as someone who finds yield pretty appealing, that certainly piques my interest, and it's certainly why it's on the radar, and it's why we chose it as an Undervalued Dividend Growth Stock of the Week article today. So moving along a little bit here, I talked a little bit about the dividend growth expectations here. General Mills has faced some challenges regarding its underlying growth as of late, with many younger consumers preferring fresher foods. This has caused recent dividend growth to slow way down. The most recent dividend increase was less than 2%. I note here that the expectation for future dividend growth is probably somewhere in the middle between, if you look at the demonstrated 10-year dividend growth rate and then what some of the more recent dividend growth has been, I think you're probably going to want to split it down the middle and say, it's certainly not 10, but I don't think 2 either. I mean, if you really think that General Mills is just going to grow its business at 2% permanently, then I don't know why you'd invest in the business. I mean, 2% growth is almost nothing. You're barely exceeding inflation, or possibly not exceeding inflation, depending on where inflation sits at going forward. Not a very good business to be growing at 2%. That's almost no growth. So I don't know why you'd invest in General Mills at that point, unless you just think the 3.8 yield is enough and use it as maybe a bond substitute or something, and you take on the extra equity risk. I don't know why you'd be into it, but I certainly don't think that's a reasonable expectation either. So, you know, people are saying, oh, the 10-year dividend growth rate is 10 plus. That looks good. I don't think that's what you're going to want to use, likewise for the most recent dividend increase. So their payout ratio, very, very high though. As I noted just a moment ago, it's climbed up quite a bit as General Mills has been pretty, they've been very gracious, a little too gracious maybe, with their dividend increases over the last decade, and especially over the last 2 years. And that's led to the bump in yield and the reduction in valuation and some change expectations regarding General Mills. That payout ratio is quite high. I mean, I've talked in prior videos about what I consider a perfect payout ratio, quote unquote. That would be 50% for me personally, because it represents a perfect harmony between, there's a balance there between a company keeping half its earnings to grow the business for M&A or whatever it might be, R&D, things like that. So it keeps half the profit aside and says, we're going to use this to reinvest back in the business. And then it returns the other half of its profit back to the shareholders, who are the collective owners of any publicly traded company. So you're saying, hey, you guys are the owners. You know, the profit is technically yours. We're going to give you half. But, you know, you guys obviously want us to be good stewards of capital. You want us to continue growing the business. We need to keep the other half, and that strikes a very good balance. It's you're not really moving the needle too much in either direction, because you're sitting right in the middle, right? 70 is really aggressive though. That's basically, General Mills is returning 70 cents on the dollar for every dollar of profit back to shareholders in the form of a dividend, and that not only limits the company's flexibility in terms of reinvesting back into the company and growing the company and whatnot, but it also limits the future dividend growth potential, because that payout ratio can't really climb much higher because of that lack of flexibility I just noted. The company needs to continue growing. I mean, it's a mature company. It's been around for more than 150 years, as I talked about earlier. Been around for a very long time. That's all fine and dandy. It is a mature business. You know, I wouldn't expect anything. You know, this isn't a technology company or something that's going to come out with some kind of breakthrough. It's not a Silicon Valley startup, but you know, you still need to reinvest back in the business. You still need to look at things and look at opportunities, and like Annie's recently, you need to look at new trends in the way people are eating, and you need to be flexible, adaptable. You need to be pliable as a business, and you need to be able to kind of turn corners. Even a mature company like General Mills, and with them paying out that much of their earnings as a dividend, that kind of limits that flexibility a little bit. So moving on to underlying growth, which is kind of how we got here, how we got here in a position where the payout ratio is quite high, and why certain expectations have been lowered, why the valuation has come way down, and everything else. Which the valuation was just really way too high when General Mills was trading way up here at 70 something a share. It was really unreasonable, and I think that was just people assuming or buying into the thought that they would be bought out, which never transpired. And of course, the stock has fallen quite a bit since that realization has come to pass. So I've got two annual reports pulled up. If you go to General Mills and Investor Relations, you can pull up all their annual reports here on the quarterly earnings there, and I've got the 2017 annual report pulled up right here, and I've got the 2008 annual report, the 10K I should say, because they have an interactive annual report you can view, but that isn't really what you need. You really need the 10K. You need the financial data, and I've got 10 years basically worth of 10Ks, because I've got 10 years ago and I've got the most recent. In General Mills, you can see their fiscal years right here. Ending in May there, so they're a little different from a lot of other companies that may end them in December. So that's why it's 2017 that I have pulled up, even though the calendar year hasn't ended yet. Their fiscal year of 2017 has ended. So that's why it's not 2016 like a lot of other stocks that I'll write about and do videos on. So getting into the growth here, the first thing we always look at is revenue. We can see net sales back in back in fiscal year 2008, 13,652, and we're going to do a compound annual growth rate on that. So we're starting with 13,652. Just make sure that's right, 13,652. And then we've got net sales here at 15.6, just a little over 15.6 billion, 15,601. I'm going to round that up to 15,620. You can see here it rounds up 15,620. We'll just call it. And then we've got 9 fiscal years because the first year is a growth year. So we've got a compound annual growth rate of 1.51, which I note right here, 1.51%, which is disappointing for sales growth. Like I've talked about many times, I start out with the expectation on a mature company for top line growth to be somewhere in the mid-single digits. General Mills was on a pretty good trajectory up until recently. You can see here 13.6. 14.6, 16.6, 17.9, and then things started to really drop off here more recently, which correlates pretty well with the drop off in valuation. So I think what happened here, not only were investors or maybe even some speculators speculating on the odds of General Mills maybe being acquired, but also the company looked a little better too a couple of years ago. So that may have pushed the valuation up a little bit as well, but still. This is a mature company. A lot of their sales are in cereal. They are a very diversified food products company, but this whole organic trend and this trend toward fresher foods, that didn't start yesterday. So to push that valuation up, again, in my opinion, was unreasonable, and that's why anybody who bought the stock in the 70s has kind of suffered with maybe realized or at least unrealized capital losses in the meanwhile, and they certainly bought at a point where their go-forward yield would have suffered as well. So the income that they're generating from their investment is much lower than what it should have been had they bought the stock at a more reasonable valuation, which is where I think the stock sits now. Yeah, revenue growth, a little disappointing. Not the end of the world, but I'd prefer to see something a little higher there, somewhere between 3 and 5% would certainly be more appealing. And that's where they were at. And if General Mills can just make a few adjustments to the business, I don't see why they can't get right back there again. And we're really looking at a pretty rough 10-year stretch here, guys, too. I mean, we have to consider that at least a couple of these years, a few of these years, included the financial crisis, Great Recession. Of course, people continue to eat. General Mills continue to increase its dividend. That's why it is an appealing idea for a long-term dividend growth investor, even when something like the financial crisis hits. You can see General Mills dividend here, $1.85, $1.90, $2.24, $2.70. I think I'm looking at earnings per share dividends. 79 cents, 86 cents, 96 cents, $1.12, $1.22, $1.32, $1.55. You can see here the dividend just kept right on rolling as if the financial crisis had never occurred. And that's why you get into a business like General Mills. You're not getting into it because you're going to expect them to just grow 15% annually or something. You're looking at it because it's a solid dividend, and no matter what occurs in the world, yeah, maybe people are eating a little less cereal than they were before, but they're still eating cereal. They're still eating ice cream. They're still buying a lot of the Pillsbury products and bakery products. They're still buying all these products, maybe a little less than they were before due to different trends in foods, but that doesn't have anything to do with the economy. Doesn't have anything to do with the economy. That's just a changing trend in dietary choices. So right through the financial crisis, they kept increasing the dividend, which is exactly why you want to be in a business like this. And really, the business didn't even suffer that much. You can see it just kept plugging along for the most part. And recently, with some of these changing trends, it's kind of plateaued a little bit. But if General Mills can just figure out, a few things with the business and just kind of keep tinkering a little bit, adjusting as they go, so a couple bolt-on acquisitions here and there, I really don't see why this company will be struggling or be in bad shape going forward. I think they're certainly placed very well with a lot of legacy brands. Retooling some of those brands is a good idea. They've done that with some of their brands like Cheerios, coming out with, a lot of companies, a lot of big food companies are coming out with, they're taking some of their legacy brands and, no artificial colors and GMO free and all this other stuff to appeal, to become more attractive toward younger people, millennials and things like that. So I don't really see why General Mills is in a lot of trouble here. I mean, and they're really not. If you look at the numbers here, I mean, they plateaued a little bit and things have kind of stalled, but it's not like the business is going off a cliff. The stock may have kind of gone off a cliff a little bit there, but again, I think that was due to mostly due to just plain overvaluation. People are paying way too much for the stock, and that can hurt you. So moving on to bottom line growth, we can see here earnings per share diluted 371, and then we see 277. And you know, you would scratch your head at that and say, whoa, what happened here? Is the business shrinking? What happened? Sales are up. Why is earnings per share way down? Well, that's whenever you see a number like that, as I've talked about before in videos, you right away want to say, okay, did the stock split, or what happened here? Look at the shares outstanding. You can see right here a 2-for-1 split. So you'd have to cut that number in half. So 371 divided by 2. We'll call it $1.86. That's probably what I called it in the article. Yeah, $1.86. And then the most recent number is 277. And we still got nine compounding periods. So 4.52% compound annual growth, which I reflect right here, which is good. Certainly doesn't support the 10% plus annual dividend growth over that same period, which is why the payout ratio has climbed. It's very, very straightforward, very simple. You know, it's just, it's a decent number for a mature company. I would really prefer, you know, I would really prefer something closer to 7-8% on something like this. 4.5 is a little disappointing. It's just like the same thing as the revenue. If General Mills came in at 3.5, 4% for revenue growth and somewhere around 6.5 or so for earnings per share growth, that'd be very solid. And they're really not that far away from getting back to that point. So again, I don't think General Mills is in a lot of trouble. Slightly disappointing 10-year numbers, but this is a very simple and straightforward company. They don't need to massively change the business. This isn't like, you know, some kind of technology that's becoming obsolete or something like that. We don't have to worry about obsolescence when we talk about food. So they're just some basic retooling, and I think they'll be fine. And really the numbers here aren't that bad. It's just that, you know, you can't expect 10% plus annual dividend growth, at least over the near term, and I wouldn't even think over the long haul. I mean, again, General Mills is the kind of company you would expect, you know, maybe 5 to 8% annual growth. We'll call it 6.5, somewhere in that range, 7 maybe, but you shouldn't be expecting 10% annual dividend growth. That's just what happened there. General Mills was just, you know, way too aggressive with dividend growth, and maybe that led to incorrect expectations that people weren't really paying attention to the numbers. Maybe that's what occurred, a little bit along with those rumors and buyout musings and things like that. So so again, yeah, not great numbers, but not terrible as well. And I also want to talk a little bit about the payout ratio. I don't know if I think I've talked about this in prior videos. You know, the payout ratio, we can see here where I got the number from. You've got a quarterly dividend at 49 cents, right? Divided, we got trailing 12 months earnings per share at 279. So you've got the payout ratio at 70 we'll call it 70.3%, right, guys? And some people will say, well, but that's just earnings per share, which can be affected by a lot of different adjustments. The true payout ratio is technically cash flow, you know, free cash flow. But earnings per share payout ratio and free cash flow payout ratio, they're generally a proxy for one another, especially over a longer period of time. They're generally not that far apart for a lot of businesses that I've looked at in the past. And I'll kind of show you how that plays out for General Mills right now. So we're on the cash flow. I'm sorry, this is balance sheet. Let me pull down the cash flow statement here for the last fiscal year. Okay, so we've got operating cash flow at a little over 2.3 billion, right? 2313. We got CapEx at 684. So we've got free cash flow at a little over 1.6 billion, right? 1629. We've got the dividends paid right here at 1135. Divided by 1629. Payout ratio of right about 70%. So you see the numbers line up pretty well. So if anybody ever looks at my videos and says, oh, well, the payout ratio he's using is against earnings per share, or maybe that's not totally accurate, it's usually, it's within reasonable accuracy, and it's just an easier number. It's a number that you'll find that a lot of people in the investment space, whenever you're looking at articles, the payout ratio is almost always a number of the dividend against trailing 12 months earnings per share, or maybe you might look at the last fiscal year depending on when you're looking at the numbers. But it's usually not all that inaccurate. I just wanted to make a point there real quick. So we've got the 10-year growth here for top line, bottom line. And of course, when looking at valuing a business, we don't invest in where a business has been, we invest in where it's going. So we want to start to develop some expectations for where they're going moving forward, using that backdrop of that 10-year demonstrated growth, as using that as a proxy for the long haul, and saying, okay, they've grown at 4.5% moving forward. Are we starting to build some expectations based off of that? we can start to make some estimations off that, certainly. And I also like to look at what we think they're going to do going forward. And CFRA is a tool I like to use. It's a professional analysis firm I use in all the Undervalued Dividend Growth Stock of the Week articles, along with Morningstar's numbers. And what CFRA does is they project out what they think the compound annual growth rate for a company's earnings per share will be moving forward. And they've got that right here at 7%. So they're basically saying that they think General Mills is going to accelerate their bottom line growth a little bit based off of what they've done over the last 10 years. And as I noted a few minutes ago, I think General Mills is the kind of company where that's where you're looking. You're looking at maybe 6 to 7% bottom line growth over the long haul. And so they've done 4.5. That's a little disappointing. There are a few reasons for that, I think. But moving forward, if somebody came to me and said, if somebody built a time machine and came back in time from 10 years from now and said General Mills grew their business at 6.5% over the next 10 years, that would not be surprising to me. I wouldn't say, wow, yeah, that's incredible, or oh, that's disappointing. I'd say, yeah, that's about what I think you'd expect for General Mills. So, CFRA believes it's going to be 7 over the next 3 years. It's not a stretch, I don't think. And I think when you're looking at 4.5 over the last 10, 7 moving forward, you start to kind of blend those numbers together, and you can start to make some expectations, start to build some expectations from there. One area of potential, and this is noted in the CFRA report, is international sales. And that's because the vast majority of the company's sales, of General Mills sales, come from the North American retail and food service product segment. So less than 1/4 of the business is international for General Mills. So that leaves a lot of potential for them to grow the business. I can tell you, living in Chiang Mai, Thailand here, I eat out for pretty much every meal because food here, there are food stalls all over Chiang Mai, and the food is really delicious and very, very cheap. There's no need for me to go buy groceries and cook and clean and do all that stuff at home. And I live in a pretty small apartment here, which is really nice. But whenever I actually had to go to the grocery store yesterday to get some food because a lot of places in Chiang Mai, well, across the country of Thailand, are going to be closed for a ceremony for their late king. And so I had to get some food because I can't just run out to a food stall because they're all going to be closed today. And going there, I did see some cereal, and I will tell you this, guys, that I always, whenever I'm in a grocery store, whenever I'm really out and about, I'm always kind of paying attention to businesses. What are people buying? What's popular? What's going on? I did that a lot in the US. I do that a little bit less here because things have shifted and brands that are popular here, I might not even be able to read the package because it's probably in Thai. And it's not like I'm going to be investing in Thai companies. I'm not going to be going on the Thai stock market or anything like that. So a little different over here. But I did pay attention a little bit because I was in a grocery store that sells a lot of Western groceries. It's a very popular place for expats and things like that. And I will say that I did see some General Mills products in some of these baskets. I did see people buying some of their food. So there's certainly some demand there for it, not just from expats. There were also Thais in there as well. There's certainly some demand for it and certainly some growth potential there. I mean, when you're talking about a quarter of a business that's been around for 150 years, only a quarter of it is international. I mean, that's just a huge runway for growth moving forward. So the North American market may mature and start to plateau and maybe even move in the opposite direction as younger millennials. And part of that is just due to the fact that America is becoming a wealthier country, and buying prepackaged food is, I don't know if it's beneath people or just a health thing, or but people have a lot of money, which relates back to the initial point I made on being smart with your capital. But it ain't a situation anymore where you just you need to worry about price so much when it comes to food. People have a little bit more choice, a little bit more disposable income. They can pay up for fresher food and things like that. So there's some trends there moving against General Mills in the domestic side, but I think there's a ton of growth potential, a huge runway for them internationally looking forward. Moving on to some other fundamentals, we got the balance sheet next, the long-term debt to equity ratio and the interest coverage ratio. Getting into the long-term debt to equity ratio, as I've talked about before many times, it's a bellwether metric. It's a number that a lot of people look at, use, want to know, so I include it in the articles. I don't really place a lot of importance on it because I don't think it's really all that, I don't think the information is all that valuable. Nonetheless, we'll break it down for you guys. We got long-term debt here. Right here, you see 7.6 billion, 7642. Actually, I'm going to round that up because you see 76429. I'm just going to round that up. And then you've got total stockholder equity at a little over 4.3 billion right here, 43.279. We'll round that up, 43.28. So you've got a long-term debt to equity ratio rounded up at 1.77, which I reflect right here. And then the interest coverage ratio, we move back up to the income statement. And we're looking at EBIT against interest expense. So we've got earnings before income tax right here, 2271. We're adding back in the interest expense because that's already been taken off, 295. And we're dividing that by the interest expense. And we've got an interest coverage ratio. Did I do that right? Yeah, we got an interest coverage ratio. I thought I maybe did something wrong there for a sec. So we got an interest coverage ratio of 8.7. It's a little under 9. It's okay. It's an okay balance sheet. Just like some of the other numbers we've been looking at, General Mills is not a company that's going to go out and just wow you with growth and incredible balance sheet and this and that. But it's a food company. It's a business that sells cereal and ice cream. And especially with the way the stock market's been over the last few years, you know, that kind of business isn't as cheap as it once was. But I think relative to a lot of other opportunities, relative to the industry, relative to the broader market, really relative to where General Mills has been, especially recently, you know, it's a very good business. Is it outstanding? Could the balance sheet be improved? Could the growth be better? There's definitely some room for improvement here, but it's an okay. The balance sheet is okay. An interest coverage ratio, so what that means is they're covering interest expense off EBIT almost 9 times over. It's a good number. I'd prefer to see it a little higher. Anything under you know, a 2 or 3, you start getting into low single digits. That's worrisome, frankly. Anything really below 5, I start to get a little uneasy and uncomfortable. 9 is okay. It could be improved a little bit, but not bad. Next, we're getting into profitability here. CFRA used to include this information, and they've recently revamped their reports, and so they don't include it. Used to be over here. You'd see 5-year average for net margin, return on equity, and net margin has just gone to NM. I don't even know why they do that now. So I've just moved over to Morningstar and just averaging out the 5-year numbers here, which is pretty simple. And you can see here that they're usually pretty accurate. You see the earnings per share here, 185, 277. We see revenue, 13,652, 15,619. That's all accurate. The payout ratio is all. Morningstar, like I've talked about before, is if I had to put a number on it, I'd say they're about 95% accurate or so. Very reasonably accurate if you're short on time and you don't want to pull up 10Ks. You should always pull up your 10Ks. You should always pull up the 10Qs. You should always pull up the financial statements. You should always be comfortable and familiar with a company's investor relations site and all of its financial statements and press releases and things like that. However, that said, Morningstar is a pretty good substitute, especially if you're crunched for time. So getting into net margin here a little bit, we're going to take 5 years, just average it out. We're just looking for a simple average, just as a rough baseline, say, okay, where's their profitability at? I'm just taking the last 5 years, dividing it out. 9.684. We see here 9.68% rounded down. Pretty good net margin. We're almost in the double digits. That's very solid. For this space, that's very good to get almost near 10% net margin. I have no problems with that kind of profitability. I don't know if Google Finance will compare them a little bit, see where they're at. You can see Kellogg here, which is, I'd have to look at their numbers again. I haven't looked at Kellogg in a little while, but I think they're even more reliant on cereal than General Mills, if I'm not mistaken. But they've got, you know, the net margin here is almost half. You can see some of their competitors here. You see Unilever down here. I mean, the net profit margin is great. I would have no issues with that. I'm a shareholder in General Mills, and if I were a potential investor, I'd look at that number and say that's actually really good. Return on equity, same thing. If we do a simple average here. Whoop. $29.43. we can see here 29.43. Again, very solid numbers. I note here these are very strong numbers for the space. Net margin for the most recent fiscal year came out, we're almost cooking near 11%. That's really, really strong. I don't see why you'd have any issues with these numbers at all. Profitability is outstanding. And one thing I noted here in the article, which I don't know if anybody picked up on, I didn't catch any comments for it or any feedback, but I said, Trix, of course, is a General Mills brand, cereal brand. I say, and their famous tagline is Trix are for kids. Well, Trix are for kids, but dividends are for adults, right, guys? And really, frankly, I don't mind a bowl of Trix every once in a while myself. So I don't know if Trix are just for kids, but anyways, it's a tagline they use for years. It's kind of an ironic thing, a funny thing, but Trix are for kids, dividends are for adults. Well, General Mills delivers on both. They deliver the Trix for kids, they deliver the dividends for adults, and right here I note that I believe General Mills will continue delivering on the latter, these dividends, precisely because of wonderful and well-known brands like the former. Getting into the valuation, we're looking at a PE ratio, 18.45 when I wrote the article. It is unchanged, 18.45. That's certainly reasonable right now relative to, I'm going to close some of these tabs so that my computer will run a little faster just in case it's slowing down the video. I can't tell. But if we look at that PE ratio here, we've got the 5-year average for General Mills, 20.6, which that might be inflated a little bit because that stock was overvalued. It went on a massive run up. That number, it probably shouldn't be that high, but 18.5 is really getting down into a very reasonable number for this market. The S&P 500, the broader market, sitting well over 20, and the industry average, if that's correct, that's quite high. That's over 25. I mean, I don't know why people are paying 25 times earnings for some of these food companies, but that's getting very strong. But you can see here General Mills is definitely at a discount. You can see the yield also quite a bit higher than its recent historical average. Price to book isn't really anything you should be looking at for a food company. I mean, that really isn't an accurate representation of anything in particular. Price to sales revenue, a little higher than it has been. Revenue's kind of dropped off recently. So, again, the yield would indicate pretty strong undervaluation. The PE ratio might as well. Cash flow is also well below its 3-year average. And then you got revenue, maybe indicating more fair valuation. As I noted earlier in the video, I don't think that this stock is hugely undervalued. I think it's just a very solid food company offering a very appealing yield, and especially in this market, with some decent potential to kind of accelerate its growth a little bit moving forward. And I think there's a lot to like there about that. I'm going to close this tab as well. So we talked a little bit about where that PE ratio is sitting at relative to the broader market, the industry average. Talk a little bit about that yield being much higher than its historical average. So combining those two numbers, I think we're starting to see a trend here where the stock does look at least a little bit undervalued. I next move into the dividend discount model analysis, which I use on every article and every stock that I personally invest in. On this one here, we're going to go over to that. I think it's a 49-cent quarterly dividend. It is. That's an annual payout of $196. And I note in the article that I use a 6.5% long-term dividend growth rate for this stock. As that's kind of a number I pointed out a few times throughout the video as kind of a reasonable expectation for General Mills long-term growth, underlying profit growth. And I said that if somebody built a time machine and came back and told me that General Mills grew at 6.5% from here until 2027, I would say, yeah, that seems pretty reasonable. So what I'm baking in here with this expectation is that their payout ratio just stays high, that they don't drop that payout ratio down. What that means is that I'm assuming General Mills grows its earnings at 6.5 moving forward, 6.5% annually, and its dividend tracks that earnings growth. So what could also happen is General Mills could say this payout ratio is maybe a little higher than what we're comfortable with. We're going to scale back dividend growth and slowly start to bleed that payout ratio down a little bit. That could happen. But I think over the long haul, over the next 30, 40, 50 years, which is this dividend discount model analysis actually cooks numbers out into infinity, which none of us are going to be alive for infinity, but over the next 30, 40 years, we'll call it, I don't think that's an unreasonable expectation for General Mills. I really don't. So 6.5 is where I'm putting it. And this isn't a 2-stage, so it's just 6.5. And then I use I use the discount rate at 10%. It's not a particularly high yielding. It's getting pretty close to utilities now, for that matter, but it's not over 4%. So we're just keeping it at 10. So that gives me a 59.64 fair value on it, which I note here. I talk a little bit about the dividend discount model analysis, and I also talk right here about why I compare my fair value conclusion with that of what some professional analysts come up with. The first one we look at is Morningstar. They've got General Mills as a 4-star stock. That's out of 5 stars. 3-star wouldn't indicate fair value, so they're saying that it's slightly undervalued. They've got the fair value estimate at 58 bucks, which I note right here. And then CFRA, they rate stocks similarly on a 5-star scale. And they've got General Mills rated as a 4-star buy. So you've got a 4-star rating from Morningstar, 4-star from CFRA. And I'd really probably rate, if I were to rate stocks on a 5-star scale, which I don't, but if I were, I'd probably put it at about 4.2. I'd say it's modestly undervalued. It's a solid business. It's a low risk business. We're not talking about technical obsolescence here anytime soon, unless people start to unless they're able to like 3D print food or something in the next 5 years. I think General Mills should be around for quite a while, and I think people are going to continue to enjoy their products and brands for quite a while. So, you know, again, not hugely undervalued, but it's a pretty compelling idea in this market, especially if you're looking for yield. And really, General Mills is yielding pretty close to utilities, but I think with a lot greater growth potential moving forward. Their fair value for CFRA, we go back down here, they have it at 50.06. And here they had it at 49.48. So they moved it up, what, 50 cents or so since I came out with this article. You can see the date here, October 21st. And this article was published, I believe, October 22nd. Yeah, it was. And I wrote this article about a week beforehand. So CFRA's changed their number since I came out, but you're talking 50 cents. It's not going to change the bottom line here. I average out these 3 valuations, which comes out to 55.71, which would indicate the stock is potentially 8% undervalued here. Which, again, as I've talked about all along this whole video and the whole article, it's not, you know, I'm not presenting this idea as, hey, General Mills is 20, 30, 40% undervalued here. It's this massively undervalued opportunity and blah, 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 blah. I'm saying it's a very compelling long-term investment idea for the yield, especially for the acceleration, but for really for the overall growth potential. But, you know, you can probably expect mid-single digit or maybe a little higher dividend growth moving forward over the long haul. And you're getting a yield near 4% right now. There's lots to like there. My bottom line here, General Mills is a high-quality food products company with a corporate history dating back more than 160 years. Over 100 brands in over 100 countries gives this company massive international growth potential. While investors wait for improvements to take hold, you can count on yield near 4% along with the potential for 8% upside. This is a pretty unique combination of yield, quality, and value in this space. Dividend growth investors should take a close look at this one. Again, there are a lot of utilities yielding 3.8, 3.9, 4%, and they're giving you dividend growth potential in the low single digits. So, you know, I think General Mills is a pretty compelling long-term investment idea here, guys. It's my pleasure to present it. I hope you enjoyed the video. If you have any comments, any feedback, please drop us a line. This video will be published on YouTube as well, so if you enjoyed it, please drop a comment. We look forward to your thoughts. As always, it's my honor to present this. I humbly appreciate the opportunity to present these ideas and talk dividend growth investing with you guys. It's just a real pleasure of mine. So appreciate your time. Have a great day, guys. Thanks so much. Bye-bye.